take a moment to update us on the second quarter. It's actually the week of August 12th, and I'll be talking about kind of the second quarter and on into July and August here, early August, and just kind of a recap there, and a couple other topics that have come up as I've been meeting with clients. The first thing, just kind of a recap, the S&P 500 was, if we look back a little bit, we know it had a tough December last year. That's when it had a correction. Got all that back and then some in the first 3 months of this year. But since then, it was up for a while, and then it gave it all back with renewed trade concerns with China and that fallout there. So it's back down again. But it's interesting as I look at all the undulations of the S&P over the last 4.5 months. If you look at the change from April 1st, the change is 0.6%. So it's basically unchanged from that point in time after the first quarter rally. The developed markets are not doing as well. They're down 5% from April 1st. And the emerging markets are doing even worse because that includes China. And they're down almost 8% from April 1st. So thankfully, we do have global allocation in our portfolios, but thankfully we have a heavy overweight to U.S. over any foreign. And again, China's in that emerging markets. It's interesting, I was looking at a graph recently of the role that the U.S. plays in the global stock market. So if you add up all of the stocks in the world and put the U.S. on one side and every other company's stocks in the world on the other side, China, Japan, Great Britain, France, Germany, Italy, everybody, the United States would have approximately 60% of that total, and everybody else combined is 40%. So that does tell me, I think that the trade war will end up in our favor because, frankly, if you're not trading with the U.S., you're in trouble. That's where the economy of the world is residing right now in a large part. So I think this will work itself out. We're going to certainly have ups and downs and volatility. Overall, we're doing quite well year to date because the first quarter was so good. Second quarter being flat when you add the second quarter into July and the early part of August. On the real estate front, I see that for the third quarter, one of our commonly held funds, a Blackstone fund, is up about 2.85%, and that includes the yield that it pays. Let's take a quick look at bond yields because bonds have been rallying recently because interest rates have been dropping. Now, we don't have a lot of money in bonds. We have money as bond substitutes in fixed index annuities and real estate. But if we look at the rate that the bonds are getting right now, if you invested in a 3-month treasury, you get a little over 2%. A 1-year treasury, it actually drops to 188. A 3-year drops again, you'd get 167. So, I mean, we could buy bonds right now and get a 3-year treasury paying 1.67% locked in for 3 years, but I think there's other alternatives. Certainly, if you wanted some safe money that you could count on a return, you could certainly get a lot better rate with a fixed annuity. A 3-year fixed annuity currently pays closer to 3% instead of 1.67 for a 3-year treasury. A 5-year treasury pays 168. The 5-year fixed annuities pay closer to 4, and you potentially can get even more with a fixed indexed annuity. Though a fixed index annuity is not guaranteed year after year, it is guaranteed never to lose money in a given year, whereas a fixed annuity will pay the same amount every year. So right now that's close to 4% for a 5-year. So if you want some safe money alternatives rather than buying bonds, I just don't know how much lower interest rates can drop. And so I'm still not excited about getting into bonds, although they have had a recent rally of some sort. The 10-year treasury pays 1.9%. Doesn't get me too excited, afraid to say. The 30-year pays 2.44. So what I can take from this, we do have an inverted yield curve in that the 3-month pays much higher than the 5-year. So that tells me that people think this is going to last a while, kind of a slowdown in the economy and whatever the results are of the trade wars. But I'm not sure I share that sentiment, but we never know. Nobody knows what's going to happen, and that's why we have some of our money allocated outside the stock market and not necessarily into bonds, but into fixed annuities, fixed indexed annuities, and private REITs, and another area, DSTs. So I've been doing a lot of Delaware statutory trusts. Just finished 5 lunch and learns on that, 2 in Everett. We had an overflow there, 2 in Redmond, had 1 in Portland. By the end of the year, I'll be teaching other advisors across the country about Delaware statutory trusts. I'll be speaking in Detroit, North Carolina, Florida, Toronto, and Dallas. So I got a busy, I'll be gaining a lot of air miles, I think, for the rest of the year. So Delaware Statutory Trust, we've done approximately 90 million of those so far, just over the last probably 2 to 3 years. And they're picking up steam. I think timing is good. A lot of my clients, they're baby boomers. They're maybe in their 60s or 70s. They bought their investment property a long time ago, maybe 20, 30, 40 years ago. And 2 things are certain. Not only is my client 20, 30, or 40 years older, but so is their property. Meaning that as we age, we have less desire and less let's call it less desire to keep up on working on properties than we did when we were much younger. And our properties need more work, which means they need more money. So cash flow is often not as good as it should be. Certainly values of real estate locally have gone up a lot faster than cash flow has. So a lot of people are looking at this going, my cash flow isn't a huge percentage of what my sales price could be. I think a lot of people find out they're making between 1, 2, or maybe even as high as 3% when they add up their actual cash flow and divide that into the fair market value of their investment real estate. So they're looking at that going, maybe let's say you're earning as much as 2.5%. You might decide you want to sell it and you don't want to pay any income tax. Well, you do a 1031 exchange, and we can reinvest those proceeds into a Delaware statutory trust, and you would count on probably 100% increase in your take-home cash flow. So this is hard for a lot of people to understand. They're saying, wait a second, okay, you're telling me I can sell my property here at kind of the high of the market, not have to be an evil landlord anymore, as Seattle looks at people, and I can have better diversification in newer properties in faster growing areas of the country in the Sun Belt states, diversified by property type and location, maybe potentially greatly increase my cash flow, still participate in the underlying growth of the value of the real estate, pay no income tax now and perhaps ever because of the step up in basis, and you can do all of that with a DST. Sounds too good to be true. Well, it's not too good to be true. Other areas of the country have better capitalization rates, better rents as a percentage of the purchase price of the properties, and that's where a lot of people are going. A lot of these DSTs are located in Florida, Texas, Sunbelt states, because people in the Northeast and call it Chicago, anything north, a lot of people are retiring and moving down south. So that's where movement is going. So if you want to hear about DSTs, I will say that you have to be an accredited investor to do one, meaning that your net worth outside of your principal residence has to be at least $1 million. That can include the value of the real estate. And a lot of people that own real estate here, that alone can put them over the mark. But that, plus your 401ks, IRAs, all of that, you add all that up. If that's $1 million or more, we can have that discussion. Finally, there's also the discussion about annuities. A lot of people are hearing, hey, we're going to have a recession. We're going to have a recession. I'm not sure if we are or not. Profitability seems to be growing still, but I don't know. There could be. And so I'd certainly encourage folks that are worried about that. We can absolutely put some of your money into lower risk areas that can still have a decent return using the fixed index annuities or the fixed annuities we talked about. And finally, when it comes to cash flow, Been a lot more people retiring, of course, as baby boomers age. They want something that helps them with cash flow. There are a lot of ways you can get cash flow well above what you can get from these puny paying treasuries, and that could include the DSTs, of course, as we just talked about, private non-traded REITs, mortgage REITs. There's also some annuities that can pay really good too. The highest paying is a SPIA, a single premium immediate annuity, but you don't really have the residual value to your heirs if you die prematurely, so I haven't sold a lot of those. I have done a lot of the ones that maybe you put in an amount of money, maybe it's from your IRA, 401k that's rolled over, and you buy an annuity that starts paying you in 1 year or 3 years or 5 years. You can get one that you can wait for a while. It starts paying you, and those payments can go up over your lifetime. So there's one in particular that pays a whole lot more, but you have to wait 10 years for that one. These are the kind of annuities that protect your value, and even if you die prematurely, your spouse can get it. And if you both die prematurely, your heirs can get the residual value. So they can be a real safe way to secure retirement. Once they start paying, they can never run out. As long as you're breathing, they will keep paying. And so that's the beauty of the annuities. And so those are a couple of the cash flow areas we can talk about. So I just wanted to kind of update people. There might be some people going, oh, gee, I hear the markets are down. They are in August. They've dropped quite a bit. They've dropped to a point where we don't have any real gains in the S&P from April 1st till now. We had them in the prior quarter to that. You might be hearing all kinds of stuff about the world economy, recessions, and all that stuff. Just want to say we have alternatives to help deal with that. So if you want to get your stuff reviewed, looked at, please feel free to give us a call. We have a lot of advisors here now, a lot more than we had before. We have Michelle and Joel in the Bellevue office, Christy, Jesse, myself, Nick when he passes his test. He's been doing all the DST research and paperwork up to this point. So all of us can talk to you and go over this stuff. We work as a team. I look at everything, all the financial plans, and we certainly have all these people on our investment committee, and we're talking about the same stuff. So there's kind of just an update on what has been going on. I don't see anything to panic about. Certainly I'm not making any adjustments to the portfolios at this time. We made some earlier in the year, and I'm happy with how those are going. And so if you have any questions, again, feel free to call us. If you have real estate questions, we're really adept at that. We can help you analyze, take a look at your investment real estate to determine whether it makes sense to look into a DST or not. So thank you if you got all the way through this. I appreciate that. Thank you for listening.